following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
We are back. CME Group Market of the Week, as we do every Monday with Craig Bewick from the CME Group. Craig, good morning. How are you?
Good morning, Jim. I'm good. Glad to be back here on Monday morning.
Are you broadcasting from the vault at the CME Group? What am I looking at?
So yeah, there was some discussion when you stepped away a minute ago. I think what it is it's a piece of art, like legacy art from one of the two buildings, and you probably can't tell, but there's like sculptures of like someone milking a cow and like a chicken. So I think this is real old time CME CBOT art that they didn't have anywhere to put, so they put it in this little conference room that I found this morning.
Oh my God, I love it. It looks great. It looks it's great, fantastic.
Well, we were saying next week I think we're doing copper, so I'll come back to the same room, and that will be kind of the theme.
Yeah, awesome, man. Well, thanks for being here with us. Hopefully your weekend was good, and did you do anything fun?
I had a thing out in New York for work, so kind of missed half my weekend. Got back on Saturday night, but Chicago had, you remember, I'm sure you haven't been gone so long that you can't remember how crazy it gets when we get, that first really nice weekend. And everyone in the entire city and state is outside. Yeah. So yesterday was beautiful. We got outside along with everyone else in Chicago and walked along the lake and did all that. So it was really nice here.
Awesome. Well, I'm glad you're here with us today to talk about crude. The benchmark crude, WTI light sweet crude contract is 1,000 barrels, right? That's the size of the contract. And I just want to compare that to the size of another barrel, which is very important, which is a 53-gallon bourbon barrel. So just to put it in perspective, you can visualize how big a bourbon barrel is, right? It used to be 48. They changed it to 53 in World War II. But think about, you can visualize what that is. It's hard to visualize what 1,000 barrels of crude is. It's pretty big.
It's a lot of crude oil, right? And I think we could probably get into the product stuff a little bit later, but that is why, we introduced and have the micro crude. And even we have a mini crude. We can get into that probably a little bit later. But yeah, the standard CL contract, which you have up in front of you, is 1,000 barrels of crude. So it's, at today's prices, I think we're trading around 85 or something like that. That's $85,000 worth of crude oil in one contract.
We lost Craig for a second here, but what he was saying is the notional value of this contract, right? So it's a 1,000 barrel contract, right? It's 1,000 barrel contract. And when it's trading at a price of, let's just say $85 even, right? Then you just multiply that 1,000 times the price, and that gives you the notional value of a big crude oil contract, which is quite big. It's a big marketplace. It's not a small marketplace. So even without day trade margins, you get plenty of purchasing power. So be careful with those margins and respect those margins. But that's what Craig was talking about with the notional value of crude. I think Craig is back.
Yeah, sorry about that. I'm on a different camera now. Is that going to work? Thank you. Sorry about that. We'll get this camera situation straightened out one of these days, Jim.
Yeah, no worries. I was just going over the notional value math.
Yeah. So yeah, and just to kind of even back up a little bit, the primary or the most liquid contract in terms of crude oil that we have here at CME, and you said it earlier, is what we call WTI crude, or West Texas Intermediate crude oil. And I don't think it's important to get into all of the details. You might, have some details about that too, Jim. But essentially, it's a U.S. based crude oil contract versus another crude oil that is part of the global pricing of crude called Brent crude, which is more of a European based crude oil contract. And we actually trade both here, but the WTI is the more liquid. It has more volume in terms of the two different types of crude oil that we have.
Right. So the three main benchmark crude, you have WTI light sweet crude delivered at Cushing, Oklahoma here in the US. That's number one, traded at NYMEX since 1983, I think. Number two, you have Brent crude, which is North Sea crude. And number three is Dubai crude. And they all have various degrees of sweetness to them, if you will, and sulfur content. And the WTI contract is the best one. It's the lightest one for actually making product.
Right. And that's kind of how you hear it described is light or heavy. And then that kind of gets into how hard it is to refine that crude into different things like gasoline or heating oil and things like that. But I think what's really important about the WTI product is that it's been included now in kind of this global benchmark for crude pricing that's been developed. And since it has been, they say that the WTI crude oil is what we call the price setter over 80% of the time, which really kind of means that if an economic event happens or a monetary policy, anything that can impact the price of crude, it's going to impact the price of WTI the most because it's kind of the global benchmark for crude oil most of the time. And that gets into the fact that even though it's an American based crude product, all of this crude gets exported all over the world, right? So these things are, even though they might be specific and they're mined in a specific place, they get exported, and WTI is sort of the global benchmark for crude pricing.
Yeah, not only that, I mean, it's very tradable from a volume point of view. I mean, so far today, in the front month of crude, forget about the further out months, we have over 175,000 contracts traded already, and it's only 10 o'clock, or it's early.
Yeah, I think, and also in terms of individual or retail trading, crude's always been one of the more popular products here at CME. Obviously, everyone knows about the S&P and the NASDAQ and things like that. We talked about that recently. But we've always had a really big or a lot of volume from the individual trader or investor crowd in our crude oil. And I think probably part of that is because people understand it and it impacts their lives, right? Because, as crude goes up, gasoline goes up, and it's really such, that energy component of inflation is so important. Not only does it impact what you're paying for gas at the pump, but it's also going to impact what you might pay for like an airline ticket, right? Because they're using it. And so it's one of the products that we see a lot of interest from the individual trader crowd.
Yeah, no, for sure. It's a top market traded here at NinjaTrader for sure. I mean, there's a lot of us retail folks that participate in this on a daily basis. You got the micros now, which are super good.
Yeah, absolutely. Like all of our micros, we've seen that it's just kind of invited a whole new universe of people into these crude markets because, like we were just saying, and you were describing it when my camera froze, that big contract or the standard contract is 1,000 barrels of crude. So every time crude moves by a penny, your P&L is affected by $10 with that C&L. And if crude moves $1, well, obviously at 1,000 barrels, that's $1,000 move to your P&L. And so that's a lot of crude, and that's a lot of crude exposure. Whereas the micro is one tenth of that, 100 barrels of crude, such that if it moves by $1, your P&L is impacted by $100 instead of 1,000. So we've seen a ton of interest in the micros, like we have in all of our micros, really, from individual traders. And it's been a great product, and it's really very liquid product. The bid offer spread is going to be comparable to that CL product. And so very, very, very liquid and very, very viable product.
Yeah, absolutely. And this, you have the interesting thing about trading crude oil is not only do you have supply and demand factors, right? Are we in recession? What's China going to do? Are they in recession? Are they going to be growing? Are we going to be growing? Is the world going to be growing? You have that, but you also have, OPEC plus, and you have other entities deciding on production. So there's that supply function of it. And then you have trader expectation, which is driven by, events in the Middle East as an example of this weekend and stuff like that. So there's a lot of moving parts here, which causes volatility and causes price action.
That's exactly right. And I think that's, another reason that, people or individuals are so interested in trading it is because you do have all of those factors. There's, it's in some ways it's a barometer of the global health of, the health of the global economy because of what you just said. Is China in a recession? Is the U.S. in a recession? And that's going to impact the demand for crude. And then the geopolitical events, right? I'm not going to opine on today's action or why it's down today, but in the past anyway, I think when there's been news like we got this weekend, we've seen a fairly strong rally in crude because people think there's going to be a disruption in supply, maybe if there's political or military tensions in the Middle East where a lot of crude is produced and things like that. Obviously, we didn't get that this morning, but all of these things factor in to the price of crude. And I think that's, like you said, Jim, I think that makes it interesting. And then, and you said it, the volatility because of that. And generally speaking, people like to trade products that, are volatile and that are moving. It just kind of creates trading opportunity.
Yeah, absolutely. We all look for that for sure. And there's almost like this opposite risk on, risk off behavior too. I mean, we're talking about geopolitical events and how it affects the price. It's a little bit of opposite of how equities work, but it's still a risk on, risk off idea that you see a lot as well. And again, that goes to trader expectations going forward. And there's a whole yield curve forward, right? It's in backwardation right now, but you could trade out front months at the CME, right?
Yeah, it's a great point. It's another thing that makes trading these markets interesting is that you've got that concept of contango or backwardation. And, and what that means is like when a product is in what they call contango, for example, it means that the spot month or where the front month or the cash price is trading lower than the deferred expiration months. And the reason that can happen, for example, and you mentioned it before, has to do with supply and demand factors. So, what's the demand right now versus expectations, like you said, of going forward? Or even, one of the interesting things about crude is like, how expensive is it to store crude, right? Because if for whatever reason, if supply and demand, got into a situation such that there was less demand now, and so people wanted to store their crude, the price to store that goes up, which makes the price of that, longer dated crude go up commensurately. So it's, just another, way to look at these markets. And again, I think it makes it an interesting market to watch.
I mean, Craig, couldn't they come up with a better word than contango?
I know. I almost have to go look at it every time I'm going to talk about it to make sure I don't have them confused. Because
yeah.
What does it
you had
mean?
it right. You have it right. Yeah.
Right. Another thing too to point out with the micro versus the standard contract is the micro is what we call cash settled. So when a micro contract expires, as all futures do, it settles to cash. So if you bought crude at a micro crude contract at $80 and you held that until it expired and it went to, let's say, 85. Well, the only thing that happens is we're going to do one final movement of money and then that contract goes away. Whereas if you were holding the big contract, the CL, and let's assume for just a second, which isn't, I think, reality, but let's assume your broker allows you to go into delivery, which most, retail brokers aren't going to allow one of their individual customers to go into delivery on 1,000 barrels of crude. But if you did, you'd actually have an obligation to either accept 1,000 barrels of crude or to deliver 1,000 barrels of crude against that contract, which would be really, really expensive for an individual. So, now the reality is, it's easy to roll out of a contract, right? If you were holding, I think you've got the June in front of you. If you were holding the June contract and you were coming up to expiration and you wanted to, let's say you were long and you wanted to stay long, you would simply do a calendar spread where you would then sell June and buy the next month that you want to be long. And that's easy to do, but it's something that you have to pay attention to.
Yeah, for sure. For most of us, we're looking for day trade opportunities, maybe swing trade opportunities, not position trading. So that's really what's more important is volume, right? The bid-ask spread.
Yeah,
that's more important than that nuance. But it is a positive thing for micros, just in case. NinjaTrader is pretty good at giving you a phone call. Hey, Craig, you might want to liquidate. You might want to liquidate this position.
Yeah, right. And there's, you guys have risk managers that are watching that, and you're absolutely right, Jim. I think that's more of just kind of another nice thing, but most people aren't holding this through expiration or to expiration. But it's just another difference between the two contracts.
Yeah. And your CVOL tool, let's talk about that, because I know that I'm going to pull it up here. I'm going to pull up a screenshot. I apologize for this Word document, everybody, but this is what we got today. So
yes.
Let's talk about this chart.
So CVOL is CME's proprietary volatility index on 5 of our 6 asset classes. So essentially what it is, and we could do a whole thing on implied volatility and options, but basically what implied volatility is the options markets, how much movement the option market is pricing into the futures contract. So it's a forward-looking measure, not a backward-looking measure, and it's simply an indication of how much movement the options market is saying it thinks is going to happen in the underlying future. So the dotted line is actually the price of crude there, and the solid line is our CVOL index. And the difference between CVOL and what you might often see, which is like at the money implied volatility, is this proprietary index doesn't look at just one strike. When it looks at implied volatility, it looks at all of the strikes on the options curve. So we think it's a very representative way to express implied volatility and what the market or how much implied volatility is really being priced in. So that solid line is the CVOL in WTI crude options. And you can see starting around, the end of March, beginning of April, we saw a pretty big move up, right? From, call it like 25 all the way to, I think it was 33, 34 going into the weekend. And a lot of that had to do with some of the geopolitical headlines that we were starting to get out of the Middle East. So you can see that as, those kind of tensions heat up, the options market starts to price those options higher because because there's risk, right? If you're selling an option and you think, the potential for a big price move is going up, then you're going to essentially, that volatility is going to go up. So you can see, I just thought it was a good visual, of really the, pretty dramatic move up over the last couple of weeks is, and kind of, culminating on Friday heading into the weekend where, we'd seen some of those headlines.
So could I think of this kind of like the VIX index when you're measuring VIX versus the equities?
Yeah, and of course we're not, that's a CBOE product, but certainly they both measure implied volatility. So it's no problem, Jim. But both are measures of implied volatility. Yeah. So, where the VIX is going to measure the implied volatility in the S&P, this particular, what we're looking at here is measuring the implied volatility in WTI crude. And we have it for, like I said, 5 of the 6 asset classes. In fact, the one asset class we don't have a CVOL measure for is actually equities. But you can look at it in gold. And then I actually included a chart a little bit later on, just to kind of show that's not WTI.
Yeah, so I'm getting my head around this, right? So when these things separate, but then they track, right? So when you're looking at the underlying price, you'll see the rising CVOL. I'm going to call it CVOL. You have the rising
Yep.
CVOL. That again would put upward. You would anticipate upward pricing pressure, right?
Yeah. Now, the
Not all,
interesting
but I
thing
mean
about
that seems to be what I'm looking at.
well, it's interesting because CVOL is a measure of the magnitude of price movement. It doesn't say if it's going to go up or down,
Okay.
but there's another options measure, and I don't know if I included a chart on it called skew, which is how expensive or how high the volatility in calls are or is. So this is another one we'll get into in a second if you stay there. But
I'm
skew
just going to see
measures.
I'm just going to see if skew is here real quickly. I'm not sure it
Yeah,
is.
no, that's a different one. So
Yeah. Okay.
I didn't put
No
the
worries.
skew in there, but to your point though, skew measures how high the volatility in calls is relative to the puts. So what's interesting is a lot of times you'll see WTI options trade with what we call a positive skew or the call skew, because the market is saying that if there's a big move, like one of these outlier events, it's more likely to happen to the upside versus the downside, and that's in contrast to what you might find in the S&P skew, which is almost always negative because the market says if there's a big price move in stocks, a lot of times that's going to be, again, a really big price move. A lot of times that's going to be to the downside and not to the upside. So, and then this one I thought was interesting just because of the move we see. So this is convexity in options, which is a measure of how high the volatility in the out of the money options is relative to the at the money. So essentially, are people kind of, quote, getting along the wings, right? Are they pricing in one of these big moves up or down? And you can see, I thought this one was really interesting because of, that's a fairly large move since the middle of March over the last month in terms of those options that are out of the money, really kind of getting bid up versus the at the money options. So I like to bring this up, even if you're not trading options, you can get a lot of information from the options market on what it's saying about, what it thinks the futures are going to do.
No, because of you, me and Tom Schneider are starting to look at the of all your CVOL tools for sure. They're good pieces of information because, as you can see, I mean, just like you just explained, it's like, all right, so there's some traders, understanding the conflict in the Middle East, understanding how that could have an impact on crude, among other stuff like inflation, and saying, okay, it's not unreasonable for crude to get to 85 or to 90 or to 95 within my time frame. Therefore, I'm going to have an options play there.
Right. And if you think about it, if you're selling an option, you're obligated, and it moves past where the strike that you sold at, you're obligated, right? So it makes some sense to me, I think, that, as those expectations that we could get one of these price moves, well, naturally, the option sellers are going to raise the volatility, which all else equals raises the price of that option.
Right. I'm with you. All right. Slide number 3.
So this is, I wanted to bring this up since we're talking about crude today. And just kind of another interesting trade that you can make in crude is what we call the crack spread, right? So, and the reason they call that is the way that, it has to do with the description of how they refine crude oil, right? Cracking. And you know this, Jim. So, but crude gets broken down.
They're cracking the carbon chain, right? So it's a long carbon chain. You crack it in the right spot and you get a different product.
I knew you would know that stuff. So they call this the crack spread, and you can do crude against what we call RBOB or gasoline, right? So crude gets broken down into gasoline, and I didn't include this one, or it can be broken down into heating oil, right? So here's a chart of essentially one crude oil contract, the CL, so selling one crude oil and buying 42 RBOB contracts. And the reason, and you were kind of getting into some of this earlier, the reason that you would do that in that 42, the reason we look at it at 42 is because one barrel of crude makes 42 gallons of RBOB gasoline. So you can see, and so as because this is a chart of selling the crude and buying the gasoline, as the chart goes up, that means that the gas is getting more expensive relative to the crude oil, right? And so, one of the things, just kind of one example of what can really impact this spread, and this is just one example, but let's say we had a hurricane come through where, and knock out a bunch of refineries, that essentially make crude into gas. Well, that's not going to really impact the supply of crude oil, but it's really it could really impact the supply of gasoline. So you might see gas in that case, you might see gas get bid up relative to crude, and then that's going to really move the spread. So I thought it was an interesting concept to show. It's a trade that happens in the markets, and you can, depending on your view of how crude relates to the refineries and things like that, it's something you might want to look at.
Yeah, so that's that's a great point. This is a great example of, you have your basic product, and then I guess your input, right? We need crude to make something, right? We're going to make RBOB or gasoline, or we're going to make heating oils, another great CME Group market, which is part of that. And the people who are doing the distillation, right, the refineries, have to decide what percent to make, and where their profit margin is and all of that stuff. So they're going to use all of these pricing tools to kind of figure that out on a forward basis.
Right. So, and again, these tools are available on I use Quick Strike on CME's website to make this graph. Both CVol and Quick Strike can be found on our website, and I think they're both pretty valuable tools. This one, actually, I included this one only because we came in this morning and I saw your segment earlier. And by the way, I can't believe Wall Street got 0% in terms of favorite financial movie. But anyway, I guess it did. Trading Places is great, but Wall Street at 0 is a little bit shocking.
Greed is good.
I guess maybe not anymore, huh? Maybe society's changed since the 80s. People don't like it anymore, but I thought it was a great movie.
Yeah, Bud Fox, he was a good character.
Yeah. But anyway, we came in this morning and stocks were bid, and I saw your segment, and it looked like they were breaking a little bit when we came on. Treasuries were actually down. The price of treasuries is down. Yields were up. Oil was down. So some things that, in the past when we had the headlines that we got this weekend, you might not have expected, but I wanted to show this one because it shows the treasury. So this is CVol, and the treasury is the blue line, and convexity in the treasuries is that green line. And you can see that dramatic move, and it continued this morning. So it wasn't like we saw it Friday and then vol sold off this morning like it did in some of the other markets. In the treasuries, which obviously can be affected by geopolitical things as well, vol and convexity, so those out of the money options, continue to really get bid. And I just thought it was an interesting, since we were going to be on air, and I know we're talking about crude, but given kind of all of the headlines and everything that we're seeing right now in the market, I thought this was worth showing.
Yeah, it is. It was extraordinary. We looked at a 30-year bond chart earlier this morning with me and Tom did. And, the continued sell-off in that far duration of treasury markets is just, it's very unique. I haven't seen something so pronounced in so long that continues. So it was eye-opening this morning to see that big sell-off in bonds continue.
Yeah, because a lot of times what you'll see is, when we have these events, bonds are, what they call a flight to safety, right? And you'll see the price get bid, and then obviously correspondingly the yield goes down. But in this case, I think before we got on, the micro or the 10-year yield contract at CME was up, I think 15 basis points or something like that, or something close to that. So that's a big move, like you said, in those longer dated maturities. The last thing I wanted to point out too, just, it's important to know when you're trading crude oil, what are some of the reports and things that can impact the price of crude, right? And so every Wednesday we have those EIA reports come out, right? Those supply reports, which is an important one. Obviously, if you're trading crude, you want to be aware, and you mentioned it before, when there's an OPEC or what they call, I guess, OPEC plus now, those, because that's when, those nations get together and decide if they're going to make cuts to crude oil or if they're going to produce more crude oil. And obviously that can impact the price of crude. And one thing we do have, and it's not up now because the next meeting is too far out, but we have something called the OPEC watch tool, which uses, again, it kind of uses the options market, and it makes a probability of what the options market is saying that OPEC is going to do: cut, hold steady, or increase production. So it's another really interesting tool to look at.
Well, I'm gonna find that one and pull it up tomorrow morning. I appreciate that input. I appreciate you being here today. Also,
Yep.
in the protecting the vault there at the CME. Craig, thanks for coming today.
All right. Thanks, Jim.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.